You're listening to Bloomberg Businessweek with Massar and Tim Stenovec on Bloomberg Radio.
There's a major auto strike. Student loan payments are starting up again.
Check.
Shutdown may come back after the stopgap spending deal lapses. That could easily shave a percentage point off of GDP growth in the fourth quarter, all those things combined.
Yeah, okay. It's a big list of worries. So let's get to it, because those shocks, add them all up, and you're talking about powerful forces at work on the economy. And so it makes you think, could a recession be just around the corner? Anna Wong and Tom Orlik write about it in today's Bloomberg Big Take, which reminds everybody that when everybody expects a soft landing, brace for impact. Always run in the other direction when the pack forms. And of course, is chief U.S. economist for Bloomberg Economics, joining us here in our Bloomberg Interactive Broker studio. Love your story. We've all been talking about it. And I love how you kick it off that when everybody expects a soft landing, brace for impact. That's the lesson of recent economic history, and it's an uncomfortable one for the U.S. right now. What does history tell us about where we are today?
Right. So when we look back at 40, 50 years of recession history, it's interesting that soft landing, the mention of the word soft landing, constantly peaks right before the recession. So we saw it in 1990, saw it in 2000, saw it in 2007, saw it in 2019. And so that made us think that maybe there's a reason why soft landing optimism tends to peak right before recession. And I think that's why I think the number one reason why recession is still our base case is that the lags of monetary hiking cycle tends to be very different, even within a cycle. So just when those soft landing optimism peaks is when the stuff that has short lags start improving. So currently we see manufacturing cycle bottoming out, housing prices start turning up. Those are the places which have historically pretty short lags and entirely consistent with the models of how we estimate the lags of monetary policy. But whereas the places which has very long lags are the labor market and also labor market and also credit markets. And that's where we think when those lags finally hit, which is around the end of this year and first quarter of next year, is when you start to see these nonlinear dynamics of recession kicking in.
Okay, so speaking of soft landings, I just got to go to this, Anna. I love this in the piece that you and Tom wrote. Quote, the most likely outcome is that the economy will move forward toward a soft landing. Who said that? And when did they say it? That was San Francisco Fed President Janet Yellen back in October 2007, 2 months before the Great Recession began. Okay, so we talked about that, the idea of soft landing. What about when it comes to the credit conditions that you mentioned? Like, where are we right now in the idea of, when there is going to be a recession? Like, where are we in the economic cycle exactly right now, based on your analysis?
We are at this point in the hiking cycle where the things with short lags from monetary policy, like financial conditions, housing market, manufacturing, start bottoming out, and that corner of the economy is re-accelerating. We acknowledge that. Manufacturing. But the places with the longer lags, credit conditions, and the lags we have found for credit conditions actually are longer in this cycle than other cycles. And the reason why is because the pandemic policies have led to many households having this buffer of excess cash. But even then, we estimate that over 80% of the households are now seeing their inflation-adjusted amount that they have in the bank is restoring back to 2019 level. So even there, that buffer is going away, and which is why we think that the lag should be kicking in terms of credit tightening.
And is that the big difference, Anna, why this cycle, maybe in coming out of the economy falling off a cliff, understandably so because of the pandemic, the cycle maybe after it, where things were feeling good, getting better, was longer because of the unprecedented amount of stimulus that came in. And that's why we're just trying to figure out when that's all over. And we're starting to see signs, right? When it comes to household balance sheets, things are changing.
Yeah, Carol, I think, so we look at the world with many models. We don't just look at one model. We also use our common sense, judgment, and all of that would point to that there is a part of this economic cycle that's very predictable. Like the hit of initial rate hikes on manufacturing completely predicted by economic models.
Right.
The part which is not is exactly the credit conditions. And I think the reason that you explained is exactly right, that it is that the household have more money in the banks, and either because they didn't spend as much during the pandemic when everything is shut down, or because they have received these fiscal stimulus checks, or the stock market is booming, right? So now all those things are eventually going away, and probably going away in a couple of months.
Right.
That's where we expect to see the hit.
Question for you, because the job market continues to show signs of strength, although maybe a little bit of softening, but it's still unbelievable. Will we potentially, though, have that recession with a strong job market, or no? The job market, again, the lag effect takes a little while, and it's just a case before we start to see the unemployment rate tick higher.
Yes, you do need the labor market to turn down in order to have a recession. And, Tim just gave a quote of Janet Yellen foreseeing a soft landing in 2007. In that same month where Janet Yellen gave that quote, non-farm payroll was showing 160K of hiring. So, this Friday, we're likely to see around that ballpark again. But that does not tell you that you can't have a recession 2 months later.
It can change that quickly.
Yeah.
The data points.
Very much so.
Because I do feel like, Tim, we're in this environment, right? We've seen it where companies, if they're getting a little worried, a little bit nervous about the outlook, they start to shed jobs pretty quickly.
They do, but we've spoken to some analysts who've said, they were so hard to find these employees during the pandemic that we're seeing labor hoarding right now, and that we, companies don't want to let people go as a result of that.
Yeah, I've heard that as well. And we did look very deeply into this issue. Mm-hmm. And what we have found is that in all the other recessions in the past 50 years, this idea of labor hoarding always is very popular on the eve of a recession.
It's not new.
It's not new. It's even in the
point.
first quarter, second quarter of a recession, because there's the aspiration aspect of it, right? Nobody wants to fire anybody. So, of course, they want to hold on to, workers. But when reality hits the corporate balance sheet where nobody's spending, your profits falling away, you cannot hold on to those workers. So layoffs usually happen about 3 quarters into a recession.
How quickly does inflation, though, get back to that 2% target then? Because I feel like I'm listening to you and I'm thinking, if inflation still somehow stays above 2% for whatever reason, and I'm wondering if it could still stay high even in a recessionary environment, could we have that? And does the Fed continue to raise rates?
Our baseline outlook is that we will see a stagflationary light kind of situation going forward, where you have growth slowing down, but inflation, the sticky part of inflation, still hanging around about 3%. This is why it's stagflation light, because it's not like inflation is going to 10%, right? It's just 3%. It's still above the Fed's 2% target. And the Fed has been very clear that if they see that inflation is sticking around 3%, they will do more to get back down to 2%.
That makes me nervous, especially if the economy is starting to come undone. Sorry.
Yeah, this is a nerve-wracking story to read. It's like the first thing I read for the week, and I'm like, oh, this is some great news.
Happy Monday.
So where are the cracks starting to appear? Like, where should we be looking right now?
I think the shocks that we're hitting. So the history of recession shows that there are only really 2 reasons why we fall into a recession. Number 1, Fed rate hikes. Fed always murder expansions. Number 2, shocks, and oil shocks particularly. So when you have all these shocks, we mentioned in our piece, we are having an oil shock, we're student repayment, and also UAW strikes. All these individually are very small shocks, but when you have all of them at the same time, like the UAW strikes by itself, we estimate that the 25,000 UAW strikers could affect, 130,000 jobs in about a month or 2. So once you have that unemployment rate jump, then you could kick off like these nonlinear
So
dynamics.
Anna, you're telling us Taylor Swift cannot save this economy?
I saw that Beyonce's on-screen tour is only coming in December. It's too late for Q4.
But Taylor has already kicked in about $5 billion into the economy. Right. Not enough. Not enough. All right. This is a must-read story. It is among our most read, and it is today's Bloomberg Big Take, which means our editorial team says you should be reading this. The world at large should be reading it. Anna Wong is, of course, chief U.S. economist for Bloomberg Economics here in our studio.